it's been crazy. Like, there's been distress, the markets were all over the place. Like, what have we lived through in the last 7 days?
Liquidation now, ask questions later. And I think that's the reason why correlations have broken down. But, you know, yesterday the markets hit a bottom and they came back up. And when we look at oil in specific and commodities more generally, the dead cat bounce was really a dead cat bounce. It was relatively small, which I think is telling you a lot, that there's still a lot of risks left in the system. And when we look at the overall tariffs, they're the highest in a century. They're still at 25%. And then second, when we look at who got hit the hardest, it's the superpower of manufacturing. And then the other thing to keep in mind, and this goes to oil and commodities, U.S. is the largest exporter in the world and producer of oil. China is the largest importer of oil. So oil and commodities are in the crosshairs right now. And, you know, when we look at China, I want to emphasize in the United States how they fit together. Yep. The United States is a barbell economy. It's got tech on one end, commodity production on the other. What sits in between? Everything China has. And so when we think about where this trade war currently exists, everybody, you know, viewed as reprieve because everybody else got a 10% and China was elevated to 125%. China is the critical component here relative to where the U.S. sits. So I think oil probably has this right in repricing the risk again this morning.
But do you think, are we headed towards a severe recession in the U.S., but even globally, even with where we are now, this like 3-month reprieve, or could we at least be headed to like 2008 crisis style?
Well, I think, you know, the situation is radically different because it begins with policy. The policy put is kind of, you know, benign, to say to be kind here. And I think that the risks here are very different than anything that we've ever seen. I think what happened yesterday was a liquidity issue. And you could see it in gold. Gold sold off. When you're in a crisis and gold is selling off, that's telling you got a liquidity problem. And then, boom, you know, they came out with the reprieve. Gold bounced back up, which is telling you that, hey, liquidity came back into the system. So I think, you know, that the environment we're dealing with is not like 08 and those other environments because it's policy driven.
Okay, but will this kill, for example, U.S. shale?
I think that's the biggest risk here. What is the U.S. biggest dog in the fight? It is the oil. In fact, I like to point out, what are the 3 Bs of U.S. exports? Bushels, barrels, and bombs. Those are the big 3. And the biggest one of them all is the barrels. It's $350 billion of exports. And here's the critical point. As you ask the question, shale is highly supply elastic. And so when we look at what the U.S. exports, bushels and barrels, they're fungible. China can get them from Brazil. They can get the oil from OPEC. The problem with the U.S., all the stuff that China exports is non-fungible, which means they can't go other places to get it, which means the U.S. consumer is going to feel more of this than what the Chinese consumer feels. So
your base case is what, that the U.S. president realizes and then does a U-turn like he did yesterday also on China, or how does this end?
Yeah, I think how it ends is who's going to feel the most pain here. As you ask, shale, we get below 55, which we were last year. Even the Permian shuts down. Below 65, you're shutting down other parts of the shale patch. The other one that's getting hit hard are farmers, the bushels. So when we think about, you know, which are the congressmen to break ranks or the lawmakers to break ranks in the Republican Party, they're from states that have farmers and oilmen. In fact, who is it? It's Nebraska, it's Iowa, it's Texas that are now beginning to break ranks. And so you ask you, where is it going? The people that are going to feel the most pain are these commodity producers.
But so are you expecting, so first of all, how quickly could we go to those levels? And are senators and governors going to start going to the White House and saying, hey, hold on, this is a massive mistake, because I'm going to lose my constituents?
I think we got there yesterday. You were at $56 a barrel in WTI. We're down at that point where you're now digging into the cost curve. And let's not remember the decline rates on U.S. shale are massive. It'll just drop off a cliff as you begin to cut expenditures. And these cycles are rather quick. I like to point out the United States in 2020 through 2021, from April 21, oil prices went negative. It shifted in being a net importer. This could increase the current account deficit because they lose their biggest dog in the fight. And by the way, you get the wheat prices when they're an exporter, and by the time they swing to being a net importer, you were back to $100 a barrel.
But Jeff, this spells disaster.
Yeah, we look at the commodity markets. They are the most supply elastic. It goes back to my point. You got to recognize China has non-fungible goods it's exporting. United States' biggest dog in the fight are fungible commodities that are very supply elastic.
But Jeff, if you're China, you just play the long game, right? You try and support the economy and wait this out.
That's, you look at what you learned in 2020 and 2021 during the pandemic, that production came off really fast. Which means that the drop in production could impact the current account deficit in a negative way. Because, again, what was the biggest driver of the current account deficit over the last 50 years? It's oil.
Where does all of this turmoil leave the energy transition?
When we look at it, it improves the energy transition. I like to point out a security-driven energy transition is faster, more profitable, and cleaner. And proof in the pudding. The energy transition started in 1973 with the first oil crisis. From 1973 to 1993, we saw massive investment in nuclear power, renewables, and the rest of it. It dropped fossil fuels from 94% of overall demand down to 85%. The Net zero 2050 transition took you from 85 to 81, and it was expensive and it was difficult. So when people are scared and energy security is a priority, they act quick. And I like to point out, you need to have energy security over affordability over the environment, and you'll get there.
But even in the U.S.?
So
this is like an unintended consequences of what this trade war looks like.
Yeah, I'd like to point out, France has the lowest carbon emission footprint in the world because of its nuclear power. It didn't get there because it wanted to save the climate. It got there because of energy security issues. So there is a silver lining in the cloud here, per se, but energy security is typically a much faster and quicker driver of a transition.
Jeff, is there any way that the U.S. at this point can avoid a recession?
I'm not the macroeconomist, and when I get in there, but I would argue that in energy, the shale patch is going to go through a really difficult time here. You're already feeling it. And let's not remember, when we think about oil prices, I know that the administration targets 50 to 55, which is below the Permian break-even. It's going to cause problems. The United States is the world's largest oil producer and the world's largest oil exporter. Really low prices are a bad thing for the United States. And you saw this in 2015, and you saw it in 2020. But let's look at 15, because it was different. Yes, it benefited Chicago when the oil prices came off in the northern states. But by the time the CapEx came off in 2015 and 2016, it was detrimental to the U.S. economy, because that's a lot of CapEx and jobs that would be lost from the energy sector.
Jeff, given all of this, has OPEC Plus made a terrible mistake? Will it fall apart?
Yeah, I think their 400,000 barrel per day increase last week was a shot across the bow to the rest of OPEC members as well. Do not cheat. Now, the problem with that explanation was the following morning on Friday, Russia came out and backtracked on shutting down the CPC pipeline. So somewhere there was probably some pressure on Russia somewhere there. But I think the key point there is, when we look at the situation right now, there's a lot of downside risk here. And you and I have been doing this for a while. We know that this oil market, it doesn't do three-point landings on 50 to 55. Odds are it's going to overshoot to the downside.